And with that, I want to welcome Alex Morsink from Equivesto. How you doing, Alex?
I'm doing great, Craig. Thanks for having me.
It's always good to have you. The feedback is always great, and I love today's topic. So let's get right into it. When we're talking about what to look for when investing in startups, as a startup coach, investors want me to recommend startups, and now with equity crowdfunding, anybody can be an investor. But the problem is you don't know what to look for.
That's definitely a challenge. There's a lot of different investments out there. There's different platforms offering different things. And so today we're really going to focus on how can you as an investor look at your personal investing goals and find investments that fit your goals and your targets from the pool of investments available from equity crowdfunding, and then how to look through those investments and make sure you really understand them from a perspective of an investor so that you can make a decision that you're comfortable with. I'm going to cover four key areas: understanding your own personal risk tolerance, understanding the company that you're considering investing in, understanding the actual terms of the deal and the way that you will be investing in the company, and then important sources of information. What documents are available to you as an investor through equity crowdfunding, and where can you find those? So the most important thing when you're thinking about any investment is understanding your own risk tolerance at the beginning. People always reach out and say, okay, tell me the best place to put my money. I want to make 150 million% return in 10 seconds. I want to get super rich, super fast. Tell me where my money should go. And really, investing doesn't exactly work that way. There's no get rich quick schemes that don't involve exceptionally high amounts of risk. And so usually when you consider investments from a holistic viewpoint, if you want shorter term investments that you'll be able to move your money in and out of really easily, so they're very liquid, that means that they're going to be lower risk. There'll be less volatility, so the price won't move up and down that much, and it'll be consistent. If you want really great large returns, to get those returns, you're going to have to go through more potential volatility, more fluctuations in the price over time. And that is in turn going to mean there's more risk associated with that investment. It also will probably mean that your investment will be locked in for a longer period of time. And so with that sort of scale in mind, it's important to sit back and look at yourself as an investor and think about what you are comfortable with and how that aligns with your own goals. So how much risk are you really willing to take with your investments? That's the first question you have to ask yourself. And it really is exactly like what I just described. The more potential for return, the greater the risk will be, because that's really that volatility, that fluctuation. You want the price to go high, you want it to become more valuable, it's going to fluctuate up. That means it could also fluctuate down. Next, you want to think about how this is going to fit within your own investment strategy. So if you are someone who, let's say you're in your, late 50s, early 60s, you want to retire in the next 3 to 5 years, you've already got a large sizable nest egg, you should be looking for, based on your sort of life structure and timing with retirement coming up, the assumption would be you're looking for investments that are shorter term with more liquidity so you can get your money out. And because you'll need to live off your money soon, you don't want that money to really fluctuate a lot in value. You need to be able to count on getting that money out so you can pay your bills, buy groceries and everything like that when you retire. On the flip side, you're a young professional who's making a strong salary, working in the city. Your salary more than covers all of your expenses, and you're putting money aside to save for longer term goals far in the future, 10, 20 years, because you don't need that money right away. You've already got your sort of rainy day fund. You can be putting that into higher risk investments that are going to fluctuate much more, but because you're investing for a longer period of time, you can ride out the fluctuations. So if it fluctuates up, that's fantastic. But also if it fluctuates down, because you don't need the money right away, you're not in a position where you have to sell it and sort of realize that loss. You can keep the investment in there and then allow it to fluctuate back up again in the future. Equity crowdfunding is one of the highest risk investments that exist. You're investing in very new, small businesses that have just entered and are potentially entering a new market, minimally tested with not a lot of experience, bought a lot of hopes and dreams for success. So right now their value is much lower, but there's a lot of potential value in these kind of businesses. Each one is different. So we'll talk about understanding the differences between them in the next section. But you want to keep in mind that with these investments, your money's going to be locked in for 5 to 7 years at least. And it's really up to the company and the decisions the company makes that's going to translate to your ability to sell your investment and actually realize your returns. So with that in mind, you want to make sure that these type of investments do fit your own personal goals. And even within equity crowdfunding, there'll be some companies that are a little bit less risky and a little bit more focused on consistent returns for investors through something like a dividend, which is a payout of a percentage of the profitability of a business at the end of the year. Or there'll be companies that are really sort of moonshot ideas where they're either going to be really successful and they'll create a lot of value in a long time, or they won't be, and you're really taking on a lot more of that traditional startup risk. So before you do any reading or reviewing of investments, you want to think about how much risk you're willing to take on. And you want to think about how this fits into your holistic strategy. So yeah, because equity crowdfunding allows a minimum investment of only $100, you could most definitely decide, yes, the majority of my money, I want to make sure it's safe and secure. So I'm going to put this in, lower risk mutual funds or something like that. But I want to take a small piece of it and do something a bit more exciting and speculative with it. And then, having that $100 or $200 to invest in equity crowdfunding is fine. But you want to make sure you do understand those risks and the differences between the type of investments available to you as an investor before you get involved. What is great about equity crowdfunding is it makes investing in private businesses finally accessible to the general public. Prior to this, the minimum investment in a startup was usually $25,000 or $50,000, and you needed to be an accredited investor. So now with equity crowdfunding, this high risk asset class and type of investment is now available to the general public. So you even have the ability and opportunity to make that choice. So I think it's really great that this is possible, but you want to make sure it does fit into the amount of risk you're willing to take on. So next, and probably the most important thing, and so we'll spend more time talking about this now and also when we go through the different documents, is picking the actual company available through equity crowdfunding for your investment. So you want to make sure that you can take the time to review the information that's provided to you about the company and make sure that you feel comfortable with what the company is doing and its goals and everything related to the company and its offering before making your investment decision. So the first thing you want to make sure to understand is, what do they do? How does the company actually make money? They can be an exciting industry, doing exciting things, saying cool stuff, but how is this company actually going to go out, create money in this industry, turn that revenue into profit? What do their expenses look like? And how is this going to potentially translate as a return on my investment? Once you've figured out how they plan to make money or how they will be making money, do you think that is really feasible based on what you're reading about the company and its industry and the documents that are provided? You want to think about whether this makes sense to you. Do you think the company can actually go make money here? Of course, Equivesto has done due diligence on all the businesses on the platform before they're even available to the general public. But the level of our due diligence is to make sure that we believe the business is, of course, legitimate, legal, and also a great business opportunity. But that doesn't mean that it's going to be one of the businesses that fits your beliefs and your understandings. And you want to make sure that you're investing in something that you understand and feel excited about. Next, you want to think about what their goals are. Different companies on platforms like Equivesto and equity crowdfunding can have very different goals in terms of their own growth, in terms of investor repayment, and in terms of their sort of profitability and future plans. So you want to think about if it's more of a small business style company. So they're looking to, get up and running, make consistent profits and pay consistent dividends to their investors. If they want to, be more startup style. So they want to go from nothing to a global powerhouse, and their exit opportunity is really going to be when they, go public on a stock market at, $1 billion valuation or something ridiculous like that. And any company in between, you want to think about what those goals are and how they'll impact you as an investor. Do you think that those goals are realistic, and do those align with your own investment goals? Next, you want to look at what they've achieved so far. Do they have any traction? Traction is usually defined as sales or customers, but if they haven't had any sales yet, then it can be a list of pre-orders or a waiting list, or, in worst case scenario, just Instagram followers or something like that. You want to see if they've actually talked to anyone who could be a potential customer and if there's any interest from that market. You also want to think about whether you would buy their product or service if you were their potential customer, whether you see value in it yourself. And then you want to think about what stage is the company at. Are they post MVP, which is the earliest stage that's possible on the Equivesto platform? So they have a demo version of their product or service, but they haven't started selling that to customers yet. They're post revenue, so they've started selling their product. They have revenue coming into the business, but they're very early in that stage, or they're in the growth stage. They've been selling their product for a while, and they're now trying to scale their business. They've proven that the model is successful, and they want to make it more successful and larger. Next, you want to think about the leadership team. When looking at a startup, this is one of the most critical areas that you can look, because the business hasn't really been tested in the market yet. It's still very new and very early. And the people who will be guiding this company from this small idea with just an MVP, where it is now, to the future opportunity, is this leadership team. And those individuals are really important for you to understand, their background, their history, and whether you feel that they're the right ones to lead this company. So Equivesto does full background checks on these individuals. We provide education checks and verification, experience checks and verification on all of these things. But you want to make sure that you take a look at this information and feel comfortable in the people leading the company that you're going to be investing in. Next, you want to ask, am I excited by what they do and their mission? Equity crowdfunding is a great opportunity to invest in companies that are making an exciting change in the world around us, either locally or nationally or globally. And you want to make sure that when you're choosing what you're investing in, that it's also something that you really care about and you believe it. That'll help you feel more comfortable about that choice. And even if the business isn't successful in the long term, you still will have supported something that you care about and you want to help grow in the future. Do their future expectations make sense to me? This is also important. You want to look at their goals and plans that I mentioned, and some of the beliefs and assumptions they're making about the future state and their own growth, and see whether those make sense to you as someone considering the company for investment. If they've provided financial projections or a business plan, or even a slide covering their financial projections in the pitch deck, you want to look at those and make sure you take the time to think about whether, the sales number they've posted for year 3 really feels like it makes sense to you. If a company's saying they're going to do 2 sales in year 1 and 10 sales in year 2 and 500,000 sales in year 3, maybe there's something missing there that doesn't make sense. A company that says that wouldn't make it through to list on Equivesto, but you get my idea. You want to make sure you understand the assumptions that they're making every step of the way, and whether you agree with those as someone investing in the business. And of course, you want to make sure you understand the risks associated with this company and this investment. So as part of an equity crowdfunding round, companies are required to list out in the offering document, which I'll talk about later, a whole list of all the risks associated with their business model and the risks that they face actually implementing this company and their vision. So make sure to take the time to read all of those and feel comfortable about the risks that the company is facing, and whether you believe the management team and the company will be able to overcome them in the future. Next, it's important to look into the terms of the deal. As someone investing through equity crowdfunding, you're purchasing shares in a business. So you're becoming a shareholder in a company, and being a shareholder comes with different rights and obligations. So it's important to understand exactly what those are. Different share classes carry different rights and obligations, and every company has the choice to create custom share classes that have their own specific rights and obligations. So make sure to take the time to review in the legal documentation attached to the deal, including the offering document, again, which I'll discuss later. What are your specific rights and what are the rights tied to your share class? Do you have specific rights to special dividends? Do you have rights to special votes, or do you not have voting rights? Are there any protections for your share class? One thing that Equivesto ensures that every company that raises on our platform has are something called tag-along and drag-along rights. These rights specifically exist to protect minority investors, minority shareholders, individuals who invest very small amounts in the company. And these rights essentially protect investors from being screwed over by management in certain ways. So those are required for companies raising on Equivesto, but make sure that you understand any other rights and protections that you have listed in the offering document or the shareholders agreement. Next, you want to look at the company valuation. What is their valuation right now? The valuation determines the price per share that you will be investing at. The value of the company essentially is what we think it's worth now, but also based on what they're going to try to achieve in the future. And if you take the value of the business and divide it by the total number of shares that are being issued and already exist, you can determine the price per share, which is the amount that you're investing at. So it's directly tied to the price that you're paying for the shares. And so by buying the shares at this price, you're supporting the company's current valuation. Think about the strength of the team, their future goals, and what they've achieved so far, and whether that comes together to sort of create and support the valuation that you'll be investing at. Equivesto works with all of the companies raising on our platform to make sure that they have a fair and reasonable valuation. We don't want it to be too high, obviously, because that goes against the benefit of the investors who are participating and can damage the company in the longer term in case they have to raise in the future and they haven't made future progress. And we also want to make sure that the company is priced fairly to protect and value the founders and the work that they've done so far. You also want to think about how many actual shares you're getting for your money and how many shares are out there in total. That tells you the percent of the company that you're buying. With $100 or even $1,000 investment, given companies are usually between a $1 and $5 million valuation at the sort of early startup stage, you're not going to be getting a large percentage of ownership personally. It's quite often that the entire equity crowdfunding round itself will only be worth something between 5 and 20% of the whole business. So your percentage that you're investing and purchasing might be, 0.0001% or something like that. But you do want to have an idea of who has how many shares in the business, who has the control positions, and what are you getting for your purchase. Who else owns a large amount of shares is important because you want to understand who is really going to be making the decisions. Sometimes the CEO of a company isn't its largest shareholder. And so you want to make sure you understand who are all the players in the business and who is going to be supporting the management team as part of the company moving forward and picking leaders if the management team ends up not going the right direction. Oftentimes, the leadership of a startup is its initial founding shareholders who have the largest ownership percentage, but it's important just to have an idea of exactly what's going on there. That's all outlined also in the offering document, which I will talk about later. What are the expected exit possibilities? Again, every company is different. And even on the Equivesto platform, there are different types of companies with different goals. So it's important to read the terms and also look at the goals of the company, excuse me, to understand, where are they planning to go in the future, and how will that lead to opportunities for you as an investor to get paid for your investment? With equity crowdfunding, there is no secondary market, which means unlike the stock market, you can't turn around and sell your shares next week or the week after. There's going to be certain opportunities where you as an investor can see actual returns and have your money sent back to you. Those are outlined more on the Equivesto website in our Learning Center, but essentially it's limited to going public in the future. So a company would list on a stock exchange and you could sell your shares there. The company could also be bought by another large organization, and then all of the company's shares, including yours, would be sold to that company, and then you would be paid for that. And the company can issue dividends. So you would still own your shares, but the company would pay a percentage of the annual profit to its shareholders. Sometimes it's only certain classes that would receive that dividend. Other times it would be all classes of shareholders. So then you would get potential return on your investment through those dividends. And another thing you want to look at is how often does the company plan to provide shareholder updates? The company is legally required as a corporation to have what's called an annual general meeting, or an AGM. This meeting should be open to all shareholders to attend, and that's where they can provide updates on what they've done over the past year and their progress. Also, at Equivesto, we highly recommend that every company issue quarterly email updates to all of its investors, so you are up to date on what they're doing and how they're progressing. Now that we know our own goals and we know what the company is up to, the most important thing is to make sure that the business that you're looking at matches your own personal investment goals, which I've alluded to before. So based on my own risk tolerance, does the terms of the deal and the potential timeline for the returns match my goals? Sometimes you're looking for a high risk opportunity, but you want it to be a little bit less high risk and you want it to pay out sooner. So you would be looking for a company that might pay some potential dividends in a 3 to 5 year period. Or you might be looking for investing in something that's got a truly groundbreaking idea, but it's going to take them 5 to 7 years to really scale that and really become valuable. And then their plan is to go public in the future. So then your investment is taking a chance on this exciting idea, but you're not hoping to see money back from it for the next 5 years. Next, do I believe that they can achieve what they hope to? And am I willing to take a chance on this company? You really want to think about this company and what their plans are and how they fit and connect with you as an individual. Are they going and doing something that you disagree with? If you are really focused on protecting the environment, are they going out and doing something that's causing environmental damage? You want to make sure that the company reflects how you feel and what you care about as an investor. Do I think the business will be profitable? I would highly recommend avoiding investing in businesses where you don't see how they can make money in the future, especially after doing all this work. Even if everyone is saying this business is really exciting, you should invest in it. If after reading everything, you still don't understand how they are going to make money, I would recommend saying no to that business because that wouldn't be a good fit for you as an investor. And then finally, you want to think about how much money you actually want to put towards this investment in high-risk businesses. Companies on Equivesto and on any equity crowdfunding platform raise in campaign-style raises. So they're available for investment for only a limited time. So that means, a company available for investment this week might not be available in 6 months, but a company available in 6 months might not be available for investment now. Given that, you don't necessarily want to take your entire amount of money that you've allocated to invest in higher risk investments and put it all into the first company that you like. You probably want to keep some aside so that you don't put all your eggs in one basket and you have multiple different options of companies that can make you more money and are existing in this much higher risk investment category. So I would highly recommend, instead of putting $1,000 in one company, putting $250 in 4 companies or $100 in 10. Now we'll talk about different sources for information. Where can you actually go to gather all of this detail that you need to make the decision about a company available for investment through equity crowdfunding? So the home base of all of their information is going to be the equity crowdfunding offering and the campaign page. It's the same thing. This is going to be where they have the outline and introduction about the business. There's potentially a pitch video here, and it's going to give you a wonderful introductory walkthrough, what the company is doing, its goals, its management team, and give you some of the details of the deal. Attached to this campaign page are all the rest of the documents that I'm going to refer to here. So there's a pitch deck attached. Pitch deck is a specific document, usually in a PowerPoint or PDF presentation style, which provides a clear outline from the perspective of an investor. So it's going to talk about, what the problem is, how they're going to solve the problem, how the company makes money, the traction they have so far, how much money they're trying to raise, and the team, all sort of in one short slide deck. Next, and what I would describe as the most important document, is something called the offering document. In Canada, there's different rules that allow equity crowdfunding, but the majority of the crowdfunding rules all require something called an offering document. This is essentially a legally binding document which the company submits to the regulators at the end of the campaign and provides a holistic outline, sort of from A to Z, about everything related to crowdfunding and their specific offering to investors. So this talks about everything that I've listed here on the slide. So the terms of the deal, the details of the company, background details on the founders, control of the company and shares outstanding, the risk of the company and the investment, the rights for the specific share class being sold, the history of any other crowdfunding campaigns that this company has done, funds that have been raised so far and what they've been used for, the planned use of the funds that they're raising through this campaign, and considerably more information. So I highly recommend reviewing the offering document prior to investing. It can be long, it can be up to around 30 pages, but they're always in the same format and template because it's a template provided by the regulator. And so once you've read a couple of the offering documents, you should get an idea of where you're trying to find the core pieces of information that you as an investor are looking for. Another document that would be attached to the campaign page would be the Shareholders Agreement. So this document outlines the rights of all of the shareholders, how the company is controlled and governed, what can be done with the shares specifically, and more information. Make sure you understand your rights and obligations as a shareholder and as a shareholder of the specific class that you're purchasing. It also talks about who is on the board of directors, so who are the individuals who make decisions about how the company is run and governed, and how much power does the board have, how often do they meet, and what power do you have as a shareholder? What must be decided by shareholder votes, and do any shareholders have special votes or veto power? And what restrictions are placed on me as a shareholder? That's all contained in the Shareholders Agreement. Some optional documents that can be attached to the campaign page include a business plan, which is a longer, detailed document, which outlines the company, its business model, industry, competitors, marketing plans, sales goals, etc., which is the most detailed document that you'll have looking at the company. There'll also potentially be some company financial statements. So these will be looking into the past and would be an income statement and a balance sheet, which would show you what the company has done so far, if they've had any revenue, their expenses, and any assets and liabilities they have. Are there any debts that you didn't know about? How are their expenses looking? These are all great pieces of information that you can learn from existing company financial statements. There'll also potentially be financial projections. These are forward-looking guess documents, which basically provides you some insight into what the company is hoping to achieve in the future. Projections are almost 100% of the time incorrect. So don't look at it and believe that's gospel truth, but it provides a great window into understanding how leadership thinks, their assumptions they're making, and what goals they're trying to achieve as they grow the business. And last, there'll be the articles of incorporation and any amendments to those articles. So these are the official documents that actually created the company and creates the ground rules in terms of the types of share classes that exist and how many shares can be created for each class. So this just sort of supports okay, the share class that I'm buying legally exists and these are its rights here. So there's a whole lot of different sources of information, but they're all useful to look at, starting with the campaign page when thinking about what investments work for you for equity crowdfunding. And I would highly recommend reviewing the offering document prior to investing. So why invest via equity crowdfunding? It gives you as an investor the opportunity to take a chance on some exciting Canadian businesses. You're able to support local Canadian founders and business owners and help them succeed. And it's a great entryway for you as an investor to learn and understand how to assess companies and get into more business thinking, investor thinking, and dive deep into how companies are successful. And most importantly, there's a low minimum investment. And so, with $100 investment, even if the company goes down, because you only invested $100, that's all that you've lost. That is a great opportunity, and I'm so glad that we're able to finally offer that in Canada. As I mentioned before, the minimum investments used to be much, much higher. So the fact that this is finally possible is really exciting, both for myself as an investor and as someone operating the platform. A few things to keep in mind. There are some investor protections. So if the company, there's a typo in my slide, but if the company does not reach its raise goal, the capital raised so far in the campaign is totally refunded. So if a company says they're trying to raise, $500,000 and they only raise $450,000, all of the funds are actually refunded to the investors with no fees. There's a 48-hour backout window for all investors after you make your investment decision. So if you make the choice and you're going for a walk the next day and you realize, that was the wrong decision, you can change your mind, no fees, no questions asked, and have your full investment refunded. And as I mentioned earlier, there's those tag along and drag along rights for your share class, which are required for all companies raising on Equivesto. Thank you very much for listening. If you want to learn more, you can head to equivesto.com/learn. We have an entire learning center dedicated to both investors and issuers, companies raising capital. So you can look there for the answers to all of your questions.
That was great, Alex. Really appreciate it. Does Equivesto team validate the financials in any capacity?
In terms of validate, that's an important question. We are not auditors, so we don't provide audited financial statements. If companies are providing statements, they will explain the type of statements they're providing. They can provide statements they've prepared themselves, which we have reviewed, but that just means we're reviewing to see if they sort of make sense, but there's no sort of certification or promise or anything associated with those. There's also there's notice to reader statements, which means they've been prepared by an external accountant, but the accountant is just making sure that it's prepared in accordance with accounting rules and not that it's certified. The next level is a review engagement. So that's a bit more intense with a bit more review, but not a full holistic. And then of course, the top is audited statements, which means the accountant has gone through every single expense and revenue line item and checked it against an invoice and bank statements to make sure that that's all real and correctly accounted for. Audited statements can cost between $10,000 and $50,000 to prepare. So most companies do not have the capital to pay for audited statements. Projections, as I mentioned, are all 100% speculative. So when we review those, we are really looking at the assumptions that companies are making. So if a company comes forward and says, we're going to have a bajillion sales in year one, we would turn back and say, we don't really believe this assumption. We would question that so that it's as realistic as possible. But again, there's no certification or guarantee tied to those whatsoever. They're very speculative statements. With regarding any financial statements that the company does provide that aren't prepared by an accountant, as part of doing an equity crowdfunding round, the company has to certify, essentially, they have to promise that every piece of information that they're providing is true and accurate. And if any of that ends up being incorrect, then obviously they would be sued, and anyone who invested under that information would be licensed to a full refund. They'd be eligible for a full refund under that. So hopefully that answers your question. But no, we don't provide a sort of certification for any of their statements.
Are investments only common equity, or can they be participating preferred as well?
Um, that's a great question. They can be a variety of shares. It's actually decided by the company. There are certain share classes that are eligible for equity crowdfunding, and those are common shares, preferred shares, and any type of item that converts into common or preferred shares. Those are the types of shares and investment vehicles that are eligible for equity crowdfunding. But within that, companies can come up with a share class that makes sense for them. We often see companies raising using non-voting common shares. And that's simply because they want to avoid adding complexity to the investor's perspective. As a shareholder who's buying, a maximum investment of $2,000 or something like that, 2,500 in a company worth $5 million, you're getting 0.001% control of the company. So your vote has almost no impact. And so by providing them non-voting shares, they remove a lot of the paperwork that would be required for issuing voting shares.
There's another question here from Richard. Um, he assumes the offering documents show how much of the funds raised will actually end up in the hands of the company after payments to founders and cost of fundraising. Is that true?
That's definitely true. We would generally refuse a company raising on Equivesto if they plan to have payments to founders as part of the use of the funds of the raise. That's generally frowned upon. You don't want to have a company going out for external investment the first time and all they do is pay their founders. So usually we would not allow them to proceed if the majority of the funds or pretty much any of the funds would be used to repay the founders. Equivesto's fees are documented on our platform, and we take 7% of the total raise as a success fee. So if the company is raising $100,000, we take 7,000 of that as our platform fee. The other 93,000 would go to the company, and the companies are required to break down how those $93,000 are being used in detail. So, okay, 15,000 to marketing, 20,000 to, procurement, all that sort of stuff is all in the offering document.
Now, you mentioned your fees here, and that was the next question. It's 7% for a successful raise. Is there a fee to sign up or anything else?
So for investors, there's no fees of any kind. So the investor comes on, it's free to sign up, it's free to do anything. You just purchase your investment and that's it. We don't take any fees from the investors at all. For companies to apply, there's a $2,500 non-refundable application fee. We only charge this fee after we've determined that the company is a fit for Equivesto and we want to proceed. But this covers some, but not all of the costs that Equivesto undertakes to complete the full due diligence on the company before they can raise on Equivesto. And then there's the 7% success fee. So if you go through and you run around, but it's not successful, there's no additional fees for the company there. Companies will probably also undergo fees related to marketing the campaign and also legal fees. We do our best to try to minimize both of those by providing a lot of education and free templates, both on the marketing and the legal side. But companies should still plan some of their budget to cover those costs, which are not included in our fees. Those would be to third-party entities, but they're related to the crowdfunding.
If people want to invest, where should they go?
Equivesto.com. As soon as you get there, there's a button that says investors. You can click that. There's lots more information about how it works and a nice sign up button at the end. And then you can just hop in there and fill out the forms.
Thank you for the time, and we'll be talking to you all next week. Thank you, everyone.